Hello everyone and welcome to another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner Practitioner, and I'll be your host for the next half hour as we talk about all the issues related to your money, how you make it, how you keep it, and hopefully how you help it grow as well. So we've got a special show on tap. I'm going to call this a Money Pros special edition. One of the most significant pieces of tax reform legislation in our history was just passed right before the end of 2017, and we are just now getting our hands around exactly what it's going to mean for taxpayers. So no other better time to have our tax pro, Greg Porcaro, CPA and partner with Otrando, Porcaro Associates, with us for the entire show, not just for the middle segment, as we wade through what we consider to be some of the most substantial parts of this bill. So we are by no means going to cover every comma and semicolon in this thing, and honestly some of it's probably still yet to be written and sorted out, but we're going to try to sort through the major details. So the piece of legislation that was passed, the Tax Cuts and Jobs Act of 2017, many are calling it the largest piece of tax legislation or the biggest tax reform since the mid-'80s, what we call TRA 86, which I believe was back in the Reagan administration, was signed into law on December 22nd of 2017. So this is a brand spanking new piece of legislation that affects virtually every American, certainly anybody that's going to file a tax return, and is effective for the 2008 season. So it's important to point out to people that as you get ready to file your tax return with a deadline of April 15th, you're filing that as 2017 taxes. So those rules have not changed. What we're talking about are the rules that are going to be in place for 2018, and you and your tax professionals are going to be coping with this stuff throughout the year, and it's going to come to a head in April of 2019. So without further ado, let's leap right into this. Greg, thanks for being here. I don't know how you managed to sort through this stuff.
Well, some would say since it happened on December 22nd, it was kind of like a Christmas present. I'm not sure it was one I would have liked at that point, but it's certainly good for a lot of people.
And we talked about doing this show, and I said, all right, send me your summary information. Ladies and gentlemen, sent me 19 pages, and that was a summary of the legislation.
A brief summary.
A brief summary. I'm sure there was a lot of things left out. So we're going to try to break this down. What we want to do in our first segment here is we want to talk about the significant parts of the legislation that address businesses. So first up, we're going to be talking about businesses, and this covers a lot of people. This isn't just if you're a C corporation, but we're talking about S corps, potentially partnerships, Schedule C, sole proprietors. So we're talking about anybody that owns a business can be impacted by that. So let's put a slide up, and we're going to walk through these points we think are some of the biggest pieces of this. By no means everything, but some of the biggest pieces. So let's talk about first corporate tax rates. In my estimation, you may disagree here, this was one of the biggest reasons this legislation got done. Is Republicans in particular, perhaps even some Democrats, wanted to do something about U.S. corporate tax rates that most people agree were high relative to other countries. So what can you tell us about what the changes are?
So that was a primary goal for that reason, that it was perceived to make us uncompetitive on the global market. And this definitely applies to just C corporations who actually pay a separate tax from individuals. And the good news for people in that situation, and we don't have a lot of those clients left, but for those taxpayers that are still C corps, the tax rate dropped from 35% to 21%. That's a significant reduction, and obviously the hope is that those companies will reinvest that money in people, in equipment, capital, in order to help grow and become more competitive globally, which hopefully increase the GDP for the United States. That's the hope. Now, there's no obligation, unfortunately, for them to do that, so there are skeptics out there. I'm kind of one of them. Maybe they won't reinvest as much as we had hoped, and they'll either buy back stock or increase dividends. Some companies have taken a progressive action to show that they, quote-unquote, appreciate this and are trying to reinvest. Hopefully that will continue.
So we're going to have to see, but corporate tax rates, if you're a C corp, significant cuts to the tax rates there. We'll see what the impact of that is economically. Next one, and I think we want to spend a lot of our time talking about this because this could affect everybody from a very large manufacturing business all the way down to a baker, who's got one employee or something like that. And that is the treatment of pass-through entities. So when we talk about a pass-through, what are we talking about? And then how how are things changing relative to how they are in 2007?
So this is a very common form of business for, like you said, all types of businesses, from large to small. And a pass-through basically means the entity itself does not pay any taxes. Whatever income is generated or lost flows to the owners of the company, and they have to pay the tax or use the loss, whatever the case might be. So it passes through to the person, and the person has to, if there's income, pay tax on it. Many, many businesses. And in fact, that sole proprietors are included in this is really even broader than I would have anticipated, honestly.
And so how is it changing? What is the potential advantage now that they didn't have a year ago?
So this was designed to take into account that if we're going to give big tax breaks to big C corporations, we got to give big tax breaks to basically all other businesses. And many, many businesses, like I said, operate in the form of an S corporation, a partnership, LLC, or sole proprietor. So this was how they did it. They didn't reduce the tax rates enough, which we'll talk about a little bit later, but they created a deduction that didn't exist before. Now, we can't spend enough time
because it's complicated. Who gets it, how much they get,
I'm going to be clear with everyone about that. It is very complex, and some of the definitions and terms are still being understood and comprehended by someone like myself and others to figure out what does it mean, what are the nuances, and there's definitely going to be some.
So there's a lot of changes there. We've got about a minute left. Let's talk about these last two here. Next up is 100% cost recovery. What can you tell us about that? You feel
this is important because this is one of the few things that are retroactive to September 27 to 2017. So if businesses bought equipment from September 2717 to December 31st, they may be eligible for 100% expensing in that quarter, not just 50% is what we had last year. So this is a big deal, and we spent a lot of time with clients making them aware of this for their plans for equipment purchases.
Because this is something that could impact something they did at the end of last year as well. Last one, interesting change, maybe not significant, but I think interesting change to deductibility of certain fringe benefits if you're a business.
The key is entertainment. So they distinguish meals, which are still fully deductible up to 50% like the old rule. So if they're business-related meals, you could deduct 50% of them. Entertainment used to be subject to that same limitation. If it was related to business, you could write off 50%. That no longer exists, and entertainment is a broad category. The typical example is season tickets, for example, to like the Patriots. That's considered entertainment to the extent it was used for business with clients, customers, whatever. That's no longer going to be deductible. So that's a big change, and I don't know if everyone...
So golf outings, taking people
other
to a
than
Patriots
meals,
game?
The meal portion would still be deductible up to 50%.
Not deductible anymore.
But the golf, taking your client out for golf...
Well, I'm not reconsidering my season tickets to the Patriots, but
hopefully
it does
most
make it
people
a
will feel that way.
little less attractive. All right, don't leave, because up next we're going to be talking about how the Tax Reform Act affects individual tax filers. So stay with us, there's more to come. All right, welcome back to our tax reform edition of the Money Pros, and we have our tax pro Greg Porcaro with Otrando Porcaro Associates here, and we're wading through this stuff. First up, we talked about impacts to businesses. Now we want to talk about impacts to individuals, which is certainly probably the majority of the people that are watching the show. Well, everybody out there is an individual. They may also own a business, so that's really a separate topic. Anyway, so this affects everyone. So let's put up another slide. We're going to walk through 6 points that we think are the most significant aspects of tax reform that viewers are going to be interested in. So let's throw this up. And number one, we're going to talk about tax rates. So just like corporate tax rates change, individual tax rates changed as well. So let's talk about that.
So quickly, the individual rates, we still have 7 brackets. The only real difference is it now goes from 10% to a high of 37%. And
where it used to be 39.8 was the high, right?
That 39 point, right. So we got a little bit of a tax savings, and even the congressional analysis show it doesn't really, that doesn't change the landscape for individuals that much. I was hoping for a greater reduction in the maximum rate.
And fewer potential tax brackets, I think, was another objective, but we didn't get there. So the rates have come down. Some of the break points where you hit next marginal tax rate, those have adjusted as well. So you may see some effect there, but not as much as maybe we had originally anticipated. Next one, now this is personal exemptions. What's happened to personal exemptions? Because this is basically money that people could write off the top depending on how big their household was for many people. So
that's right. So this is, to me, I think, somewhat of where they made a little bit of a mistake. I think they should have left some measure of exemption in place because it eliminates a big deduction for people, married people with kids. It was like $3,000 plus per child. Now it's 0 for the next 5 years. It's important to emphasize the individual changes are only a 5-year window. So you can't even, that goes by like this, unfortunately. We don't know what's going to happen after that. So this was a big change, and they're hoping in their theory that it will be impacted by the increase in standard deduction which we'll discuss, and the reduction of rates, so that'll offset the loss of those exemptions. I'm not convinced it
So,
does.
as a reminder, this personal exemption thing that you got, your spouse got it, kids got it, most people got it, not everybody, dependent on income, you could lose it. But the old joke about, have your kid before the end of the year so you can get the tax break doesn't make any difference anymore now, right? So let's talk about essentially a related thing, and that's number 3 on the slide, and that's going to be the standard deduction. Now, the thing that taxpayers always have to face when they're looking at their tax return is, do I itemize my deductions or do I take the standard deduction? You can only take one or the other, and you want to take whatever's higher because it reduces your income. How has that calculus changed? How is the standard deduction
So it's interesting to note
changed?
that only 70% of taxpayers don't itemize. So it's not as common as people think. So, and the average, according to 2014 data, was like $27,000. So they put the maximum standard deduction for a family at $24,000. For a single person, it's $12,000, and if you're head of household, it's $18,000. So they bumped it up. Standard deduction used to be much less than that, so they bumped it up to, again, try to offset some of the loss of the exemptions.
But even with the way it used to be, with the lower standard deduction, what you're saying is 70% of people took the standard deduction even when it was
Which
lower.
is surprising.
Now they've moved it up to 24, so that 70 maybe goes to 85%
It's
of
very
people.
possible, and that's where some of their simplification theory comes into play. They won't have to worry about itemizing anymore.
But what I think is important for people here, and we want to move on to the next topic about itemized deductions, is the calculus you do about if you're used to taking itemized deductions, you may not be doing that anymore. You can't just go based on what you used to do because the math has changed. So that's a good segue into the 4th one, which is itemized deductions. A slew of changes here, so we're going to spend a little time.
So this is a big deal. I mean, I'm going to focus on 2 important ones. One, the one that's gotten the most publicity is the elimination or the reduction of the ability to deduct state income tax and local property tax. As it stands, you can only deduct up to $10,000 of one or both, but no more than 10. So that's a big change. So that's what's hurt the higher income families or people who live in states where their property taxes and income taxes are high, like property taxes here in Rhode Island are high, amongst the top 5, I think, in the country. So it's a big loss of a deduction, and there's really no adequate replacement for that.
And this is why you saw people potentially standing in line before the end of the year to pay property taxes and things like that, right? Too late to do that at this point,
It's
but
too
that
late
was
now,
the idea.
and many people had alternative minimum tax, which we'll discuss briefly, so it didn't matter. So some people didn't get a benefit for those deductions anyway, but for the people that did, it's a big change.
Big deal, yep.
Big change.
Okay.
Now the mortgage interest deduction is the other.
This is another itemized deduction. Big change here. Let's talk about that.
So the old rule was you could deduct mortgage interest on your first and second home up to $1 million. That's been reduced to $750,000. But the good news for our viewers is anyone that already had mortgages in place, the rules don't affect them. So you're kind of grandfathered in. It's only new debt after January 1 of 2018. So anybody going forward looking at a limit of $750,000. So that's good. There's also a provision there for anybody who was buying a home in the 4th quarter but didn't close before January. If they closed before April 1st, and this is really important for our viewers, before April 1st of 2018, they're still under the old rules. So if they happen to be borrowing $1 million or less, they could still deduct all of their mortgage interest. The other big change, home equity interest deductions are no longer deductible.
And let's be clear about what we're talking about, home equity. The guy or gal that likes to go out and buy a new car every few years and write a check on their home equity line of credit or something like that, because that interest is deductible, is no longer deductible.
It's no longer available.
It's got to be about the house.
Even for people that had home equity loans in place before, home equity mortgage interest is not deductible. So that's a big, big change for people, and those rules are important to get their hands on. Now, most people don't have $750,000 in debt anyway. I was talking to a mortgage person just yesterday, and he said the average, like here in Rhode Island, is around 200 grand. So most people are not going to be adversely affected by this. And even in our states, we don't have all that many clients that have more than $1 million in debt. So it's a big change for those in that world.
What about second homes?
Second
a lot of people asking about second homes.
And the nice boats that qualify as a second home.
Thank you. Good to know. All right. Any other itemized deduction changes that we should be aware of?
Well, the other one that's big is miscellaneous itemized deductions. So that includes investment advisory fees, which is a big deal, to the extent you got a deduction for it. If you're an outside salesperson, you have an unreimbursed employee business expenses, no longer deductible. And the one that upset me the most, tax preparation fees are no longer deductible.
I'm right there with you with the investment advisory fees.
I know.
The clients that could deduct those in the past, no longer able to
Now,
do
again,
that.
it's for some people who were subject to AMT, alternative minimum tax, they're not losing anything because they weren't getting a tax benefit for them anyway. But there's a lot of people, particularly the employee business expenses, this person on the road, a salesperson, whatever, they're going to lose the deduction there, and it's going to have a big impact if they weren't subject to AMT.
Another important one to mention, charitable deductions. A lot of people charitably minded.
Well, it's funny, people were afraid that that was going to go away in some fashion, but they actually increased the threshold. So now you can give away more than 60%, up to 60%, excuse me, of your adjusted gross income for cash contributions. We don't see that happen. It used to be 50%. We don't see that happen that often anyway.
All right, so a lot of changes to itemized deductions. So the message here is if you itemized or took the standard deduction, you've got to reevaluate because your situation may have changed. Last two, let's talk about number 5 here, child tax credit. I think this is a sleeper change that could impact some people in a significant way.
Well, this was a big change, again, to try to offset the loss of the exemption. They expanded the income base, so now you can have a family up to $400,000 income qualify for child tax credit for children under 17.
Whereas before, anybody over 170 or so was losing it.
Whatever, right.
Okay.
There was a much lower number. And so that's a big change. They also increased it to $2,000, which is good. So they're hoping that offsets the loss of the exemption. They also added a little twist for a dependent that's not a child under 17.
Taking care of a grandparent or something like that, right?
So that would be up to $500, and it's possible, based on the interpretation of the language, that could also include a child that's over 17 but under 24.
So kid going to college or something like that. Last one, alternative minimum tax, only about 30 seconds left. What can you tell us about AMT?
The bad news is it wasn't repealed, and that upset
Stinks, I know.
So, but it was expanded to the point where it'll affect a lot less people.
And so you got to look at the limits. So maybe the normal way to calculate taxes is the way you do it, and it's not the AMT way. But those calculations still have to be run. They didn't repeal it, unfortunately. So that was an opportunity I think that was lost. All right, up next we're going to be talking about planning opportunities. Stay with us. A lot more to come here on the Money Pros. Welcome back to the Money Pros. We're talking tax reform with our tax pro, Greg Porcaro, CPA with Otrando, Porcaro Associates. Now we want to talk about planning opportunities. What are some things you need to keep track of, opportunities to lower your tax burden? So let's go through these really quick because we only have a few minutes. Number 1 on our slide, review pass-through entities. What do people need to do?
Yeah, so we couldn't adequately cover this, but there's a potential 20% deduction for business income, qualified business income. And it's important that when you do your tax returns for 2017, you talk with your tax professional, the CPA, and say, how is this going to impact me for 2018? How do I plan for that? It's really important to get a handle on it in advance and not wait till
And this is a business of any kind. It doesn't matter how big, how small, if it's a business.
Service businesses are restricted, and there are some income limits.
But it could affect them. So they got it's not big enough to worry about this. It doesn't matter. You got to look.
Actually, the smaller the better.
The smaller the better in some cases. All right. Consider your equipment needs. This relates to the expense deductions.
Like I pointed out, there were 2 components in this act that go back to 17 that dealt with depreciation. So it's important to look at what you spent between September 27th and December 31 to see if they qualify for the expensing. And there were some changes in depreciation rules in general that could be beneficial. So if you bought equipment in that 4th quarter, make sure you bring that to your tax advisor's attention and evaluate whether these new rules are going to help you.
And is buying equipment now in 2018 more attractive than it was in 2017?
Definitely better.
So some attractive options there. Number 3, something we haven't talked about yet, but we have up, keep in mind of the sunset provision. What is the sunset provision and how does that impact
Well, the individuals,
people?
Most of the individual components of this,
So all that stuff we
window.
talked about, changes, deductions,
which could change sooner,
deduction.
right? Because there could be a change in command in Washington in 18,
anything
who knows?
could happen.
So it's unfortunate we have such a limited window, and that was to basically deal with the budget restrictions in terms of trying to get this passed.
But all this stuff that we've talked about for individuals, if nothing else happens, this is all scheduled to basically go away as of 2026, essentially, right? So we'll be right back to the old system unless something else happens. Last one on our list, don't forget the estate taxes.
So families with 20 million net worth or more or less, now you don't have an estate tax problem. But I've been telling our clients, you got to assume things could change again, but more importantly, estate planning is not just about taxes. It's about the assets, how they're going to be distributed, who's going to get them, are we going to use trust? So estate planning is still very relevant. It's just not, the tax consequences might not be as significant at the federal level, but we do have state estate taxes to worry about in some states like Rhode Island.
So you still got Rhode Island, nothing changed there. Federal, they talked about maybe getting rid of the estate tax. They didn't. It got a little more lenient, but it's still there. Estate planning is still a thing, basically.
That's right.
All right, with the final word when we come back, we're going to talk about how you can figure out how this all might impact you before you get your tax return done in 2019. Stay with us. We'll be right back. Welcome back to our Money Pro special on tax reform. We've got our CPA tax pro, Greg Porcaro, here with us. Final thoughts. You know, we talked about all these changes, but you're really not going to know how it impacts you until you get your tax return done in 2019, which is a long way away. Any words of wisdom for people that want to get a better idea now of how this is going to impact their tax return?
So I happen to be watching Fox News, and there was a commentator who mentioned a website called taxplancalculator.com. A gentleman named Maxim Lott created this. So I played around with it and compared it to some of my models. It was pretty good at estimating what the impact would be. And I checked just the other day, he has updated it for the final passage of the bill. So he did it at the House version, the Senate version. Now he's done it for the final version. And it's a really, for relatively simple returns without business income, all that pass-through stuff, it's a really good, I think it'll give you a really good measurement as to what's going to happen as a result of these changes.
And what's that website? Do you have that?
Taxplancalculator.com.
Taxplancalculator.com. So if you want to get some advance notice and you're not a business,
straightforward. All you need is last year's tax return.
Right.
And
have that in your hand and get an idea. And you'll see if maybe this works for you, it doesn't work for you. There's going to be some winners and losers here, no doubt.
There will.
So we're just going to have to see. But that is what we have. We've tried to cover as much of it as we possibly can. Thank you for watching. We'll be sure to see you again next Sunday right here on the Money Pros. Good luck with this, folks. Take care.